people, this is Dr. Wang here recording. In this video, I'm going to cover Chapter 6, Risk and Return. On the canvas, I put this chapter as a separate module, different from the other module which covers Chapter 5 and Chapter 7. They both are about valuation of securities, and they are within a unifying theme. And Chapter 6 explores the relationship between the risk and return of all kinds of securities. And here are the topics of the chapter. The first one I want to cover is risk preference. Well, different kinds of people have different kinds of character, and they also have a different kind of risk preference. And some people are risk averse, so that means they dislike risk, and risk is the volatility of your payoff, or in the security, it is the volatility of returns. So if the return gets too volatile, then the risk-averse investor would like to be compensated. And that compensation of return is called a risk premium. And the level of the compensation or the risk premium depends on the risk level, as I have addressed in Chapter 5 and Chapter 7. And there are also exceptions. There are risk-loving people, these are gamblers, and they love taking the risk. They love to see their payoff getting volatile, sometimes winning, sometimes losing. And they actually rather pay to gamble. Well, if you go to casinos, you will see a lot of gamblers, and many of them know rationally that in the long run, if they keep playing the games on and on, they would be on the losing side. However, they cannot resist the attraction of gambling. Although they know they will lose money, they still play the game. And the same idea applies to lottery buyers. So these are all risk-loving people. And there are also some risk-neutral people. They do not care risk at all. When they make decisions, they are purely driven by the returns. So risk has no effect on them. In the financial markets in this country, most of the investors are risk averse, and overall, the entire financial market is a risk averse market. If you look at some other countries, like the Chinese stock market, it is really a risk-loving market because most of the people there, most of the participants are individual investors, and they have an irrational preference towards risk, meaning they love taking the risk, although the average return is not satisfying. For the risk-loving people, higher risk is associated with a lower return or lower payoff. And for risk-neutral people, there's no correlation between risk and return. So what are the investment returns? It can be measured in dollar terms. It can also be measured in percentage terms. And we have learned capital gains yield in Chapter 5 and 7. It is simply the percentage price change for a security. And this is fairly easy to calculate. For example, if you are going to invest $1,000 and after a year you would end up with $1,060, then you would have a dollar return of $60 or 6%. So what is the investment risk? And this is our emphasis for this chapter. The risk is volatility, and you can see here that if you invest in a bond and your return could vary according to different economic situation. You have the worst case, poor case, most likely case, good case, and best case. And they each come with a certain probability. If you add all the probabilities, that's 100% or 1. So the most likely case or the expected case has a 40% of a probability. The worst case and best case have a 10% probability for each. And you can see the return gets from the lowest to the highest, from the worst to best. And if you take a look at this distribution chart, the vertical axis stands for the probability, and the horizontal axis here stands for the returns. The most likely case has highest probability of 40%, and the return there is 6%. And you can see the other columns here stands for the other cases. And here is a continuous probability distribution chart. Instead of having 5 cases, we have an infinite amount of cases. And this is a normal distribution, meaning that the average has the highest probability, and the values close to the average would have a high probability, and the values far away from the average would have a low level of probability. That applies to the worst case. It also applies for the best case. And this is how we calculate the expected return. So we have different returns in different cases, and each case comes with a probability. So the expected return is the probability of one case multiplied by the return of that case. So that is one product. And in total, you have 5 products. You are going to add all these products to get the expected return. This is the Excel formula, and I will show you in a separate video. If you look at the 2 normal distributions, the blue one and the yellow one, which one is riskier and why? As you can see, the blue one is actually safer than the yellow one. Always it is the narrower distribution gets safer investment. It's because you have a less probability of having extremely low values, but for the yellow curve, in contrast, you have a more probability of having extremely low values. Although their expected level are the same, their average are the same. The standalone risk is the risk of each asset held by itself. We are going to use a standard deviation to measure the risk of a single asset. And here is the formula for the risk. This is a Greek letter called sigma, and we have a sigma squared. That means variance. And the sigma by itself is the standard deviation, and this is our guide. And we're going to learn how to calculate it in different scenarios. And the risk basically is the deviation from the average. This R hat is the expected value or the average, and each individual return would deviate from it at a certain level, and then we're going to take the square of it to take away the negative effect, make them all positive, and this squared deviation will be multiplied by the probability to incorporate the distribution, and then the whole thing will be added together, so you will have a probability times the square deviation for each case, then you're going to add them up. This is a capital letter of a sigma, which stands for summation. So you're going to sum all of these products, and then you take the square root of it to get the standard deviation. If you don't take the square root, it's just the summation, then it is the variance. For example, in this case, you are going to use each of the return minus the expected return, that is called deviation. Then you take the square multiplied by its probability. Then you have done the work for one case. You're going to done the same work for 5 cases. Then you add them up to get the variance. After you get the variance, you take the square root of it. Then you would get the standard deviation. This is how you do it in Excel, and I will show you later. Basically, you are going to use the sum product function. So why are we doing this? Why do we need to figure out the standard deviation? Because we're using it to forecast the return, and we're also using it to see what is our worst case, what will be our best case. If the returns are following a normal distribution like this, both of the curves are normal distribution, which means they have an average, and the values closer to the average would get higher probability. If that is the case, we can develop some quantitative forecast. If the return is 1 standard deviation away from the average, then we can get to know its probability. So, for example, if your expected return is 6% and your standard deviation is 10.95% or roughly 11%, that means 16% of probability the values you get in the future would be less than 6% minus 1 standard deviation 11%. 6 minus 11, that is a negative 5%. And the distribution is symmetric. You also have 16% of the time return that is greater than the average plus 1 standard deviation, which is 17%. From the shape of normal distribution, we can tell what is the probability of having certain values, either positive or negative, either extreme or mediocre. 1 standard deviation is associated with 16% lower value and 16% higher value, and a 2 standard deviation is associated with roughly 2.5% lower value and a 2.5% higher value. So take this for example, if you would have roughly 2.5% of the time that you return would get below 6% minus 11% times 2, or 2 standard deviation lower than the average. So 6 minus 22, that is going to be negative 17. And on the other side, you could also have a 2.5% of the time that your return gets 2 standard deviation above the average. So if you use a 6% plus 22%, it is going to be 28% return. So you have a 2.5% of a probability the return would be above 28%. And you can use the standard deviation to compare different kind of investment. Not only we want to have a high return, but also we want the risk to be low. So you should definitely know the risk before investing, and you should be rational. You should demand higher compensation or higher return when you are bearing higher risk. The previous exercise was about scenario-based distribution. So basically you have a worst case, best case, average case. So what about if you use the historical data to estimate the risk? We are going to treat each of the historical return, no matter it is in December, in March, or in January, we are going to treat them equally. So we are going to take the average of all the returns. Instead of having 0.10%, instead of having 10%, 20%, or 40% probability, we just treat them equally. They each have a 1 over t as the probability, the same probability, of course. And you are going to use this formula to find the standard deviation. Well, I do not require you to know how to use this formula. I just require you to use Excel to do the job, and it is really, really easy. In Excel, if you want to get to know the expected value, just simply take the average, and we're talking about historical returns where we treat each of the past return equally. And the standard deviation to solve, you just need to type in STDEV as the Excel formula, and then you select all the returns here, and then you get your standard deviation. Nice and easy. And here is the data provided by the textbook publisher. And here are 3 companies. They each come with the different returns across the years. And you can take the average of them to get the expected return. And then you can also use the STDEV Excel to get their risk level. What you see here is the market has an average 8% return and a 20% risk. And one company has lower than market return but higher risk, and another company has a higher return and higher risk. We can also form up a portfolio, meaning you combine different stocks altogether. Of course, when you do this asset allocation, you need to consider what kind of weight am I going to put on a particular stock. It could be 1%, it could be 50%, it could be 99%. And that weight will be attached to the stock return. And then you have a one product for one stock, and then you're going to add up all of these products of weight and return for each stocks. The summation will be the portfolio expected return. If you have a 2 stock portfolio from the previous exercise, you put a 75% in blending and 25% in Gormange, and then you incorporate their own risk at the expected level to get the portfolio expected return. And here is the return for different years of the portfolio. And then you do the risk and return analysis. You will see that when you combine the two stocks, the portfolio or the overall risk is lower than any of these individual stocks, whereas the return is cut in the middle. It's not that good, but it's not bad either. It's just in the middle of the two stocks, but your portfolio risk gets lower than both of them. And that's the beauty of diversification. So if you do a smart combination to form a portfolio, your overall risk, which you dislike, would be reduced. And here is the return chart for the two stocks. You can see that they have a certain correlations, and sometimes they deviate from each other, and sometimes they go together in the same direction. And the correlation would take this formula, which I do not require you. The textbook just put it there, but we are in the 21st century. We don't need to rely on this tedious formula to solve the problem. You can just simply use Excel to get the correlation. You use a Corel, then you put the stock's return, you put the returns for one stock, then you put the returns for another stock. And a correlation measures the degree of similarity for two individual vectors of numbers. So that basically shows how closely the two stocks are connecting with each other. And in this particular case, correlation equals to 0.11. So they are not perfectly correlated, otherwise the value would be 1, but they have a certain positive correlation with one another. If the correlation is a negative, if it is -1, then they are perfectly negatively related. If it is a positive one, that means they are perfectly correlated with each other. If their correlation is a perfectly negative, then you can reach a portfolio that has zero risk, no risk at all. And if you have a correlation that is perfectly positive, then there's no way you could reduce the overall correlation. If the correlation falls between the two numbers, this should be +1, sorry, then the risk is reduced but not eliminated. So here's a case I borrowed from somewhere else. You can see for stock W and stock M, here are their returns across years, and you will see their average are both 15%, and their volatility or risk or standard deviation are both 25%. And if you combine these two stocks with equal weight, 50-50 in each, then your portfolio return will be cut in the middle. You can see overall the portfolio return is 15%. It is in the middle between 15 and 15, which is the same. But what about the portfolio risk? If you look at the chart, W goes like up and down, and M goes down and up. If you combine the portfolio, then you will see the green solid line is the return for the portfolio. Is there any volatility? Not at all. So the overall risk of the portfolio is actually zero. So you made such a smart combination to reduce your overall investment risk. So what about if you add stocks to portfolio? Let's say in the United States, you have a stock that on average gives you 35% of a risk. And if you keep adding more stocks into your portfolio, make it a 2-stock portfolio, then you add another one, making it a 3-stock portfolio, on and on, then your overall risk of the portfolio will be reduced more and more, and eventually it will reach to the total market risk. Basically, if you are looking at any individual assets in any individual stock, it has its own standalone risk, which is the standard deviation of its past returns, and it can be decomposed into the market risk, which is the risk of all of a portfolio, including all of the stocks in the market, plus a diversifiable risk, which could be diversified away if you make smart combination, making smart portfolio to reduce the overall risk of the portfolio. The conclusion here is as more stocks are added, each new stock has a smaller risk reducing impact. But the thing is, the risk reducing impact will diminish as you add more stocks. And then after you have 40 stocks in your portfolio, you just reach to your lower limit. So at that point, you should stop adding more stocks, because if you keep buying stocks, there is transaction fee, and that is a cost. So you should stop when the marginal benefit equals to the marginal cost. And in chapter 5, I have a talk about the required return. And for different type of securities, they come up with a certain level of risk, and the return would adjust that risk. So each of the return would include a risk-free part. That means every investment should give a return that is above risk-free rate. The excess return in addition to the risk-free rate would be called risk premium. And we're going to use the CAPM model to define the risk premium for an individual stock. For the market, you have a market risk premium. When we call it risk premium, you should know that it's not risk. It is a return adjusted to that risk. When you use the market return minus the risk-free return, and this is called the risk premium of the market, because the stock market is riskier than the treasury bills, which is the risk-free asset. So the stock market definitely should give a higher return than the treasury bills. Therefore, there is a risk premium adjusted to the market risk. And for an individual stock, we can use the CAPM model to estimate its risk premium. So basically, upon the previous market risk premium, we will develop a correlation. It's called a beta. And this comes from the capital assets pricing model. And after a little twist, we can develop this security market line. So the individual stock required return would be the risk-free return plus the stock's risk premium, and the stock's risk premium at individual level is a market risk premium multiplied by the stock beta. I'm not gonna require you to estimate the beta, but you should know that the beta is the correlation between the stock risk premium, that means stock return minus risk-free, and the market risk premium, the market return minus the risk-free. So beta measures a stock's market risk and shows a stock's volatility relative to the market. The beta also indicates how risky a stock is if the stock is held in a well-diversified portfolio. Here is an example to calculate the firm's required return. When you have the firm's beta as 1.3 and the risk-free is 6.5, the market return is 13, then you should use the security market line or the CAPM model to get the firm's return. So you're going to first solve for the market risk premium, which is the market return minus the risk-free rate, 13 minus 0.5, and then the market risk premium multiplied by the beta to get the individual stock risk premium, and then add that risk premium to the risk-free rate to get the individual stock return. And the answer here is 14.95, which is a risk-free rate plus beta 1.3 times market risk premium, which is 13 minus 6.5. So what is the implication of using the beta? If beta is negative, that means the stock return is negatively correlated with the market when the market is going up, if stock is going down, and vice versa. If beta is 1, the absolute value of the beta is 1, that means the stock would change at the same level of the market. If it is a positive 1, then they go to the same direction, change by the same amount. If it's a negative 1, that means they go to opposite direction, but still changing by the same amount. If the absolute value of a beta is greater than 1, so that means the stock risk is higher than the market. If the absolute value of the stock beta is less than 1, that means the stock is less risky than the market. Most stocks have a beta in the range of 0.5 to 1.5. So what is the implication here? So what kind of stock should we buy? If market is going up, if you think the market is going up, you should buy the stock with higher beta. The beta value should be greater than 1. So when the market is going up by 1%, your stock would go up by more than 1%. If market is going down, then you should buy stocks with a negative beta. When the market is going down, the stock will go up. If you're not sure about the market, you don't know whether the market is going up or going down, you should play safe. Then you should buy a stock with a low level of beta with the absolute value less than 1. So when the market changes by 1%, either up or down, your stock will change by less than 1%. It's safer than the market if you are facing uncertainty. And here is the beta for major industries in the United States. In the real estate industry, we have 11 public firms or 11 stocks of such sort. The beta is the highest. So that means when the market risk premium increased by 1%, the real estate industry stocks would increase by 1.82%. And here's another example. We have a company with a beta 1.4. The risk-free is 4.25, and the market risk premium is 5.5%. It is different from the previous exercise. Instead of giving you market return, I give you market risk premium, which is the market return minus risk-free rate. So what you need to do here is first solve for the individual stock risk premium, which is a market premium of 5.5 times the stock's beta. After you get the stock's risk premium, you add the risk-free rate to it to get the stock's required return. And the answer should be C. Please verify that. And back to the previous exercise, I have a talk before. So here, from the textbook, it shows you different figures with a different kind of exercises. So the first one, if you invest $500 and after a year you get $600, your dollar return would just be the difference. You use a 600 minus 5. So just repeat that. You click this 600 minus 500, all right, to get a dollar return. And the rate of return is the dollar return divided by the 500, your original investment, not your new payoff. Okay, the next one is about scenario case analysis. So you have 3 different scenarios. They each come with a different level of probability, 20%, 60%, and 20%. And they each come with a different level of return or payoffs. You are going to solve for the expected return. You can follow the mathematical formula to get a product of each case. So 20% times 25%. All right, and then you drag it down to get all the 3 products. Then you sum them up. All right, or you can use the sum of product function of Excel. So you are going to select the first vector of numbers multiplied by another vector. All right, after you have done your specification, you're about to hit enter, but please don't just hit enter. You are going to hit Control Shift Enter. All right, you are going to hit Control plus Shift plus Enter. All right, if you just hit enter, then it just doesn't give you any value. Why you treat it differently by hitting Control Shift and Enter is because you are using vectors of numbers instead of using individual numbers for Excel calculation. To calculate the standard deviation, well, actually for this one, I do need you to at least know how the standard deviation is constructed. It is really a concept you need to know for this chapter. It is really a very basic statistic idea. The first step for these three cases, let me just color them in different colors. Okay, so the first step is to get the deviation from it. So each return will be subtracted by the expected, and I'm going to lock the expected because I will drag it down. I want all of the three returns to be subtracted by the same return, the expected return. And then you take the square root of it, all right, to cancel the negative effect. All right, and then you are going to use the probability multiplied by each of the squared deviation. Then you drag it down. The total of these products will be called variance. All right, and the standard deviation is the square root of the variance. So that's a 12.9%. You can also use the Excel formula suggested by the textbook. So it is the sum of product is the sum of a product formula. You are going to use expected return times each of the return here minus the expected return. All right, and then you take the square of them to get the square deviation. Then you close the parentheses to finish the sum. And you know that you are still going to take the square root of the summation to get the standard deviation. If you don't take square root, the summation by itself would be called variance. So what you should do here is still hit Control Shift Enter. Then this would be your answer. Here we are dealing with historical returns, and it is different from the previous exercise when we have a different probability for different cases, like 20% chance of occurrence, 40% chance of occurrence. But if you are facing historical returns, like the return in year 1, year 2, year 3, we're going to treat them equally. To get the expected return, we just simply take the average, just type in the average, and then select all the return, hit enter, nice and easy. To get the standard deviation, the mathematical way suggested by the textbook is right here. But I do not require you to know that formula or know how to use that formula. You just simply remember this Excel technique. You're going to use STDEV for standard deviation. Then you select all the returns and hit enter. Then you are done for this exercise. The next one is about portfolios. So you have two stocks and they each have different returns, and of course in this case you have historical returns instead of scenario-based returns. And you are going to treat each of the returns equally, get the average of them, hit enter, then you're gonna drag it all the way to the right to get the expected return for the next column. For the standard deviation, STDEV, then select all the returns to get the risk, then drag it to the right. The correlation is easy, correl. You select one column and another column, hit enter. All right, what I really want to mention here, it is also actually very close to your homework. The last question in your second assignment is to get a portfolio that puts 40% weight on A and 60% weight on B. So in this case, you know that the weight in A is 40% and the weight in B is 60%. All right. To form a portfolio, you should put A's return multiplied by A's weight, and you're going to lock the weights and then drag it all the way, and then plus B's return multiplied by B's weight, and then you're gonna lock B's weight. Then you drag it all the way down. Alrighty, and to get the average and the standard deviation of the portfolio, you can just simply select the same items for one stock, then drag it to the right. So this is your portfolio return and portfolio risk. You can see that the portfolio average is in the middle between A's return and B's return, but the portfolio risk is dramatically reduced. It's lower than either of A's risk or B's risk. So that's the beauty of diversification, as I said. If you can make a smart combination, you could guarantee a certain level of return with your risk dramatically reduced. In your assignment, you would have different values for A's return or B's return, but the idea would be the same. So just use a different data to do the same things.